Hello everyone, welcome to all of you for today's session. So planning in the multinational environment. Planning in the multinational environment. International environment. So euro currency. What is euro currency? For example, I am in Pakistan and I hold in my country some pounds, some euros, some yens, some dinars, some AEDs. Means when euro currency is the currency which is held by outside the country of issue of that currency. You in your country hold pound, that is euro currency. Remember, euro currency doesn't mean that it is euro. Doesn't mean. It means some currency which is held outside the country of issuance. Now, euro credits, what they are? International loans. International loans. I take loan from a bank in the UAE, a bank in the South Africa. That will be euro loan, euro credits. So euro credit or euro loan is the loan, international loan outside my home jurisdiction. That is called euro credit. Euro bond. The euro bond by company in Pakistan, and they are going to issue bonds where they are going to issue bond in some other country. They call euro bond. Outside the jurisdiction in whose currency the bond is denominated. Long-term loan raised by companies in several countries at a time. In several countries, so euro bonds. Now, so how euro bonds are issued? Actually, a company, a big company, XYZ company is a big company, they want to issue a bond and they hire a lead manager, is appointed from a major merchant bank. For example, from Citibank, we appoint a manager. The manager does all the legal formalities of the bond which they want to issue. For example, credit rating of that bond. Yes. So they contact and credit rating of that bond they get. And then this lead manager, that person organizes underwriting syndicate. Underwriting syndicate means where one or more banks or financial institution, they provide underwriter services. What are underwriter services? Well, underwriter services are basically guarantee. Let us understand first of all what is underwriting services. Yes. What are underwriter services? Underwriting. What is it? Services. Normally, banks, they provide this service that we have to issue 1 million bonds having worth of $100 million, and we fear that our bond may remain undersubscribed. Risk of undersubscription. There is risk of under subscription, that these may not be purchased by the investor. So what they do, they go to underwriter who charge fee, of course, and they give guarantee of full subscription. They give guarantee. And of course, when it happens, when they give guarantee of full subscription, students, it means that if some of the bonds or shares are not sold to the customer, are not purchased by the investor in the market, they will purchase themselves. Sorry, my screen is visible to you people? Tell me. Why it is showing me that? Just a minute. Yes. Now, so underwriting. So lead manager hire underwriting services, and underwriting syndicate. Syndicate means when more than one bank, they join together to provide the service. This is called syndicate. And more than one bank provides the service. This is called underwriting syndicate. Yes. Who agree the terms of the bond, etc., and buy the bond. Underwriters. Then the syndicate then organize the sale of the bond, and they sell to the investor, small investor, institutional investor, etc. What are the advantages of euro bonds? Bearer instruments. Bearer. What does it mean? The person who holds the bond, that is the owner. That is the owner. There is no need of transfer in the name. If you are a holder of the bond, you are the owner. Which means the owner does not have to declare their identity. Yes. Interest is paid gross. Yes. Full amount of interest that is paid. And actually, investors, anonymous. Investment is anonymous. Anonymous return. And hence, tax avoidance is there. Anonymous return. And hence, now, euro bonds create a liability in a foreign currency to match against a foreign, yes, assets. What is it? Normally, those companies which have investment in a foreign country, and they will receive return in the foreign currency. So they can issue euro bond there, just like that money market hedge, if you remember. They create liability there. So they receive interest and pay interest. From assets, they are receiving interest. They create liability in the form of euro bond. So they receive interest and pay there. Balance. They are cheaper than the bank loan. So why? Because it can be resold, transferable by delivery. I purchase a bond, I can sell to Mr. A, Mr. B, Mr. C. Transferable by delivery. Liquidity is high. Bank loan is not transferable, you know. That's why lower return is acceptable by the investor. Now, most euro bonds are fixed rate but can be floating rates. Can be. They are issued by companies with excellent credit rating, and they are normally unsecured. Means they are not secured on loan, secured on assets. And you know, people are still trusting them. Why? Because they are excellent credit rating. Yes, who's coming? So there might be issuance cost for a business. And of course, for a business, gearing goes up. And a borrower who is going to issue euro bond, we are going to issue euro bond, and we will raise money. There is a long-term foreign currency risk of exchange loss. The when it has to be repaid, exchange rate may move adverse direction, and we may suffer loss. Now, compliance with listing requirements. Now, student, by the way, these are the things, and you know, these are the tests, these are tested in exam. And these are general knowledge based on your previous information of the ACCA subjects. Now, next. Listing requirements for London Stock Exchange. Number one, so these are the requirements. Track record requirements. If you want to be listed on stocks, track record, market capitalization. So one by one, track record. At least 75% of the business must be supported by revenue earnings record for 3-year periods. Yes, means that the business level should be stable enough that it is being supported by its own previous revenues, not with the new injection of capitals. So 75% of the business level current, it should be supported by at least 3-year record, previous 3-year revenue. The UK listing required authority has discretion. Yes, they can give shorter period. The company must report significant acquisitions running up to the, yes, in the previous 3 years, what acquisitions you have made. What acquisitions you have made in the previous 3 years. They must mention, they must report. Now, the next is market capitalization. at least 700,000 pounds should be the market capitalization. What is the meaning of it? Market capitalization means that total market value of equity. At least, for example, they have 100,000 shares and they have £5 per share. What is market capitalization? 500,000. They do not meet this criteria. They do not meet. At least. And out of this, 25% share should be in the public hands. 75% may be concentrated. I am owner, my brother, my family. But at least 20%, 25% should have been issued to the public. This is the condition for listing requirements. Now, next. Future prospects. The company must show that it has enough investment for working capital for next 12 months. Company must be able to carry on its business. A general business plan should be given. Profit forecast. This must cover the latest 3-year and latest 3-year financial statements. Yes, report. Latest 3-year. Latest all is more than 6 months old. Interim financial statement. What is it? What is the meaning of it? What is the meaning of it? For example, year end is 31st December 2020. And latest financial statements have been published for that year. Now, in August 21, they are going to apply for listing. Now, financial data available is how months old? 8 months old, 7 months. So they must produce an interim financial statements as well during the year, because it is more than 6 months old. Now, next point. Corporate governance. Yes, this is the corporate governance best practices. You should memorize these. They must, chairman and CEO rate should be different. Role should be different. Person, chairman and CEO must be different persons. At least half of the board as to chairman should include NEDs. Small company should have at least 2 NEDs. They should have audit committee, remuneration committee, valuation committee. They should provide evidence of good financial control, and now this is very important, has been tested number of times. Acceptable jurisdiction and accounting standards. So IFRS should be adopted by the company which want to be listed. You see here. So these are the requirements. Any question, please? Is it clear? Any question, please? Is it clear? Good. Next, the next point is capital mobility and block funds. It happens sometimes that funds are blocked. We have invested in a country and the local law doesn't allow us to transfer money on a regular basis. They don't allow. Yes, the exchange controls are there. They are blocking foreign exchange. We have earned profit in that country, but we cannot transfer that to our country. Only part. How to deal? So funds we can. So then the ways overcome. The parent company could sell goods and services to subsidiaries and obtain payments. The amount of this payment will depend on the volume of sale and also on the transfer price. We have to take money, bring money back from that country, sell them goods at a high price, and bring that money back in the disguise of tax. High transfer price. A parent will grant you the right to make goods protected by patents. Can, yes, charge royalty to the subsidiary. That is a subsidiary. Management charges, management fee, royalty fee, license fee. Yes. If parent company make a loan to subsidiary, foreign subsidiary, high interest rates. Now, I have discussed that. How to deal with block funds. Now, the next is risk exposure. When you go internationally, you may face different political risks. Governments, just like that, protectionist measures. What are protectionist measures? We discussed it yesterday. The measure to protect home industry. Yes, by quotas, by import tariffs, or they may impose certain safety and quality standards to discourage us. Exchange control regulations may be there, then how much money can be transferred, can bring back. They may restrict the foreign company to buy domestic company. Now, a government, what I know about Mauritius, this is you can confirm me if you have knowledge that if someone wants to open a company over there, at least one of the members should be the Mauritian national. Am I right? Am I right? Yeah. This is, you see, restrictions. Actually, I tried once to create a company registered. Then I got this response. Yes, at least one person should be there. National. Yes. Now, next. The next point is dealing with political risks. How to negotiation with the government, talk to the government, discuss with them. about all these issues which we have discussed. Get insurance against threats. Nationalization, yes, this is one of the threats. That the threat is that if we nationalize that company, government may nationalize. If we open business over there, government may, by law, confiscate our investment and government say it is our company. So insurance against that. War, insurance against currency problems. Yes. Production strategy. Yes. Instead of producing here and taking our goods to that country via imports, find local producer there, produce goods there, and it is happening now. Number of multinationals, they produce locally to avoid such risks. Find funds in the local market instead of bringing international funds. Now, the next is litigation risk. Legal risks, legal impact. So there may be ownership issue, trademarks issue, technical standards of the goods, packaging, quality, pricing regulation, export, environment regulation. You see, now, so how risk? Social and commercial good citizenship. Be ethical. Comply with laws. Yes, don't do any unethical practice. Be proactive. Now, so other steps. So avoid bad publicity from a court action. The system to make sure the company should have that laws are being changed, we should be informed with those all laws. Now, internal procedures may be designed to minimize the risk from legal action. Contracts may be drawn up requiring binding. Yeah, wonderful. That whenever you enter in a contract with any party, include a clause over there that in case of any dispute, the first option will be the arbitration, not the court, to avoid that bad publicity. Arbitration. Of course, compliance cost is there. When you comply with law, now there is compliance cost, formalities, etc. However, these costs may also act as a significant barrier for new entrants, and you enjoy over their business because new business, when they want to enter, they may be thinking so much cost has to be paid, and they may not enter. Now, student, these risks have been tested multiple times, 4-5 marks, 4-5, and these are such an easy points, but this is the drawback as well because they are easy. No one gives due time, no one prepares it well. Now, next, cultural risk. Society, norms of society. You know that you cannot make marketing strategies in my country the way you can make in South Africa, in the UK. The products you can offer over there, you cannot offer there. Here. Your business norms Yes, that should be considered. Challenge, these are the challenges. Now, so students, so national culture. Yeah, this is very much important point. The degree to which a firm can use its own national culture as a selling point. Own national culture. Swiss watches. Swiss watches. Design, technology, they are known for it. It is unique selling point. German cars, unique selling point. They say we have a culture of excellence. And students, one more thing over here. So culture should be analyzed, differences. Yeah, for example, washing machine, they have given example. Some country prefer front loading machine and other prefer top loading machines. Culture. Yes. For example, in the US, they like trucks, big car, huge. As compared to Europe, you see, you do not see trucks too much over there. Yes. Now, deciding which market to enter. A business want to decide that they want to go international. So what is how they should decide? Market attractiveness. How good is the market in terms of demand and the wealth with the people? Demand, gross national products, per capita income, in other words. First of all, if we are going to sell some expensive product, luxury item, we cannot go to the uh, third world countries. We cannot. We do not have demand over there. Competitive advantage. Competitive advantage. What is it? Yeah, we are going to enter into market and we have something superior, maybe our product features. For example, iPhone, competitive advantage of their unique features they have on others. They know the market, they know the culture, they are the best experience. And risk, political stability, government intervention, and other factors which may cause a problem for the business. Which may cause a problem for the business. Now, so management of human resource. So the balance between local and expats must be managed. Yes, if the local staff is not skilled, we need to go for international. We need to hire people, skilled staff. It happens, throughout the world it happens. Expats might be better able to than local to communicate with the corporate centers. They might be more expert in that. Now, it has some disadvantages as well. They cost more. Expensive. Yes. Now, students, culture shock. Yeah, this is culture shock. That you just get surprised when you go to some other country. You're surprised to see the difference in the culture. Culture shock. The way they behave, the way they live, the way they manage business, that may be different. In my country, the organization where people work, they may be dealt in a certain way. You go to another country as an expat, they may work in a different way that are totally different. Shock for me. And when you hire, so so for HR, you may need to arrange programs, trainings as well. Now, the next topic is dividend policy and transfer pricing. RTO and Islamic behavioral finance. Okay. Dividend policy. First of all, dividend capacity, it has also been tested number of times. Two times, I think it has. Dividend capacity means how much you can pay as dividends. How much? You know that this surplus cash. Dividend is what? What is surplus? Surplus after payment of tax, investments. So this is what they can pay. So dividend capacity, free cash flow to equity, add borrowing, net borrowing. Net borrowing means new loans minus repaid loans. Dividend received from subsidiaries. Received from subsidiaries. Additional tax on dividend received. Now this is dividend capacity. This is the amount we can pay as dividends to our shareholders. This is the amount. You must know this is not a tough job. You can simply memorize. Free cash flow to equity plus net loan plus post-tax dividends received. What is that? This is the dividend capacity. This is the excess amount which can be paid as dividend. So dividend policies. Companies may have different ways to pay dividends. So then this is such an interesting topic. Again, it has been tested in the past paper. Let me tell you, this is 32 pages handout, and it is a must. Normally, it is mandatory in every paper. 10 to 15 marks are from this handout. In every paper, you pick any paper, you will find. So dividend policy, that how much dividend should be paid? How much? The first one is stable dividend. Means same dividend every year. For example, they are paying 3 rupees per share every year. They're paying that. But they have to maintain. Then for that purpose, they need stable profits. If they do not have profit, then how they will pay? For that purpose, firms create reserves. Reserve is called dividend equalization reserve, so that they can pay stable dividend. Now, cost. So this is the stable dividend. The second is constant payout ratio. What is it? For example, they say we pay 40% dividend payout ratio. How it is calculated? Dividend payout ratio. Profit after tax divided by dividend. Means whatever profit will be earned, 40% will be, sorry, this is dividend cover. This is dividend cover. This dividend over profit after tax. 40% of profit after tax will be distributed. Or dividend over EPS. But of course, amount fluctuate then. Because profit change, dividend will also change. Now, so stable dividend plus, so they say plus extra dividend. What is it? They say we will pay you minimum 3 rupees dividend. But if our profit cross 50 million, we will pay you 1 rupee more. If our profit cross 75 million, we will pay you 2 rupee more. Means then 5 rupees. So constant dividend plus extra dividend when profit is high. So student, stable dividend policy, it gives confidence of investor about the company, that it is stable business. Their earnings say, confidence is increased about company, and it improves credit rating because history is being established. And those investors who want regular dividend, they are happy, especially institutional investor. What they are? But institutional investors normally are banks, insurance companies, pension funds who have invested in the company. They take dividend and pay compensations, pay pensions. They want dividend. Dangers of, yes, limitation. It is not easier to change. If they are not paid in 1 year, people panic. People may dispose of the share. Market price will go down. So if the company pays stable dividend in spite of incapacity, you don't have money, but they have to pay to keep investor happy, then they are actually selling their own meat to the people. Now, residual dividends. What is residual dividends? That when you earn profit, invest amount in all available profitable projects until unless you avail all good opportunities, and then amount left over that can be distributed as dividend. I repeat, whatever you have earned as a profit, invest in new available projects until unless you utilize all the opportunities. And if still some dividend amount is left over there of profit, distribute as dividend. Disadvantage is it may not stable. It is not stable. So irregular dividend policy. What is it? Sometimes they pay, sometimes they do not pay, sometimes they pay less, sometimes they increase. So why? Business operations are unsuccessful, uncertain. They don't have liquidity, poor liquidity. And they fear that if we pay stable dividends, then these adverse effects will arise in the future. That's why do not give stable dividends to avoid such problems. Now, next, no dividend policy means you have not to pay no dividends because they lack funds for business, working capital, expansion. Of course, that will be policy. XYZ company, it has total shares in issue 100,000. It is a listed company. MNP company. It is unlisted. It has total shares of 75,000 shares. Now, this company wants to purchase it. Listed company wants to purchase unlisted. And they are offering one or two shares for one share of MNP. They will acquire that company. Now, how many additional shares to be issued? How many? 75,000 cross two share for each share, 150,000. 150,000 additional shares. So what will be the total shares? 250,000. Now they will issue 150,000 share to them and purchase these shares. Now out you see, so they acquired this company. Is it clear so far? Listed company acquired this unlisted company. Is it clear? But uh, something inverse has taken a place. Now they have got 150,000 shares of it. Total shares are how many? 250. So out of 250, they have more than 50% shares. This is called RTO, reverse takeover. In acquiring that company, they got acquired as well. They issued them 150,000 shares. Total share are 250,000. This is called RTO, reverse takeover. So reverse takeover. Is it clear how it is happening? Good. Now, here is the definition. Same thing has been said. So, unquoted company got acquired by quoted company, and now it got the share. So it became listed as well. They have not to, so this unquoted company, they need not to go for IPO, initial public offer. This is a shortcut, easy access to capital markets. Now unquoted company has also, now that has become quoted. They have access to the capital markets, stock market. Now its shares are being traded. They are more confidence. They will have, investor will have more confidence in that. They can sell easily those shares. Yes. So students, their value will be higher because liquidity of the shares is more, and enhance ability to carry out further takeovers. Once the share in a company are listed, the company is able to acquire more companies for share exchange. Yes. Share-based incentive plan for employees, share-based payments, they can offer because now they are recognized. So benefits of RTO. Now RTO, reverse takeover, and IPO. IPO is the way you offer share in the market, you get listing, the traditional method. So IPO is speedy. RTO is speedy, IPO is slow. RTO is 30 days process normally. That is, we take years. And manager are involved in the IPO. Manager are involved in the documentation, legal formalities, etc., etc. Well, in the RTO, it doesn't happen. Now, cost. IPO is a time-consuming process, expensive, volume of work by different parties involved, sponsors, underwriters, banks. For RTO, it has less cost. Normally, availability. When economic downturn is there, businesses are going down, it is not possible, not easy to convince investor to support IPO because there's a new company and people may not purchase share in the new company. But in RTO, it is not the case. That is easy. In the market downturn, RTO is a better option. You know that during the market correction after the busting of dot-com bubble. What is dot-com bubble? When there is artificial price hike and market is down, correction. Market makes correction. RTOs increase. And IPO, of course, people may not invest in the new company because they say already there was a bubble in the market. RTO is easy. Similarly, in the history, fall of RTO was less than IPO, following the financial crisis. Now, so you can read it yourself. Exchange analyst cover, listing analyst coverage. Yeah. An existing company will already doing business. Investors already know, market know that person, company. And after RTO, again, it continue to have the coverage. But a new IPO, new company, it may not get that coverage, that reach to the investor, to the, yes, it may not get that level of coverage. Now, so reverse takeover, the potential drawbacks. The potential drawback of, yes, lack of expertise. That when you suddenly quickly move from unquoted company to the listed company, managers may not be able to deal with the new legislation, new requirements. IPO is a slow process, and in 2 3 years, manager learn. However, RTO may hire new staff, experienced staff for that. Reputation, a wonderful. I love this sentence. RTO has been viewed as poor man's IPO. Means that company which actually thinks that if we go through IPO, we may not be accepted by the markets. We may not be welcomed by the markets. Yes. And the company that actually listing this way may be viewed less favorably by investor. They say now they are unable to sell share in the market. That's why they are going for the RTO. So RTO is under less scrutiny than the IPO. Risk is high. Yes. So less investigation. So high risk over there. Regulation. And same is the case of there as well. Now, next. Suspension. Yeah. RTO may be suspended. The Financial Conduct Authority standard view is that when RTO is announced or leaked, there will be generally insufficient publicly available on the proposed transaction. In particular, information on the unquoted company, which is contemplating to take over, it will be limited. So, unquoted company information is not available to that level as compared to listed company. So, as a result, the listed company may not be able to accurately assess its position. And hence, Financial Conduct Authority may consider suspension of trading in the shares, in its shares. The company which become listed through RTO, they say its information is not available to the investor, to the shareholder, suspend their shares. Yes, this can be rebutted. You can go for appeal and you say, no, information is available. Prove that. For other companies, yes. Our work in the listed company will not want to contemplate a scenario. Yes. They don't want this suspension because it will have a negative impact on the image of the company. Now, next. So they may say, okay, we will not involve in the transaction of purchasing an unquoted company. Because if we purchase an unquoted company whose information is not available, that may not be assessed by the investor in the market. And our share may be suspended. So we are not going to purchase you. Sorry, RTO. Proposed, walked away from the mandatory offer. Now, student, mandatory bid rule we discussed in the merger and acquisition as well. That if throughout an unquoted company, the shareholder in the unquoted company carrying out RTO and they get 30% of the voting right of the listed company. I had shares in an unquoted company. Now in RTO, I am getting shares in the listed company, and I got 30% shares or more of the listed company. Then I have to make a general cash offer to all the remaining shareholders. That's this is the price I will buy. Anyone can come to me. This would obviously undermine the reason for doing the RTO in the first place. While takeover panel will usually consent, yes, because then it will undermine RTO. One thing is that I am going through RTO. We are selling share of this company and getting shares of listed company. We are not paying cash. But law says that if I have got 30% share of listed company through RTO arrangement, for the remaining, the law say I should offer cash. But the problem is that then RTO is not going to happen if I offer cash. You got my point. Are you sure sound is not there? Are you sure? How many? Okay. That is a problem on your side, dear. So I repeat the whole story. Here, come here. This is unquoted company. Mr. X has shares here. This is quoted company. Now, through RTO, he is getting shares of this, getting shares of it, and they are more than 30%. More than shares of quoted company. Now, Mr. X, law says, mandatory bid rule, he should offer general cash offer to all shareholders remaining. This is one provision of law, but it will defeat the RTO because through RTO you are getting other shares, and other shareholders are also getting. Other shareholders of this company are also getting shares of this. So this is the problem. So two provisions of law clashing with each other. So while takeover panel means authorities will usually consent to waiver of cash offer as certain conditions are satisfied. If they may waive this condition, this one, cash offer provision, if certain conditions are satisfied. It is another regulatory obstacle which should be navigated around carefully. Yes, obstacle is there. Now, share price decrease. So which listed companies go for RTO? Which listed companies which are facing problems actually? They go for that. So because their shareholders keen to exit, they want to dump their shares. So to safeguard risk against the dumping, the shareholder need to guarantee that they will not sell share. until a certain period of time has elapsed since the deal is completed. This is called locked-up. That you sell shares of the listed company to this company. So you will not dump these shares now in the market. No. After deal is completed, 1 year, 2 year, if you have purchased share through RTA, you will keep that locked up period. Yes. Now, the next is behavioral finance. Behavioral finance. Yes. Students, behavioral finance is basically, this is the last topic for today. Islamic finance, I will discuss on Saturday, not today. Now, student, behavioral finance talks about the investors. That investor takes decision based on some psychological factors as well, not always on the rationality. So this challenge the idea that share prices are by the rational way. No, psychological factors as well. Overconfidence, the first factor. They are overconfident in their experience and they make the overestimates, make decisions. They search for patterns. They say in the history it happened like that. Again, it happened like that. They extrapolate future performance. Analyzing the past trend, future performance. Comparing peaks with the current peaks. Comparing previous troughs with the current troughs. This type of behavior can lead to herding. All people are going to buy because this are selling. And this is the reason why bubbles are created in the market. Artificial stock market crash, panic created, rush, sell. And following the crowd. Everyone is doing this, so I will do that as well. And it happens normally. It is psychology of investor. Yes, it is psychology of investor. And they are not doing it on the basis of any rationality. Now, a stock market bubble can emerge because investor buy share, just like that. Crypto, right now. You know that going up, Bitcoin. Everyone is buying bubble, and then sudden fall. Now, so demand increases from the actual demand in the market. So share price increases more than the normal. Then market takes correction. After a period of time, bubble busts and goes down. And when it goes down, it panics. And again, people start selling. And it goes down, then the level it should have been at. And then when it stabilizes, and then market take a bit correction and become normal. Now, for the crowd, actually, this is compounded by the reluctance of investor to admit. This is such a wonder. This is something which is wonderful. And this happens because I have taken a decision. I cannot call myself wrong. Cognitive dissonance. Narrow framing. Investor actually unable to see the bigger canvas. They say, okay, today, tomorrow, It is happening. What is happening in the bigger canvas? They don't see. Then availability bias. Availability bias. They make decision based on prominent information, recent information, and they don't make decision based on a bit rationality and with appropriate calculations. They make decision on the availability. Yes. So one factor is sometimes you see conservatism. Investors and managers are resistant to changing in their opinion. Hence, if a company's profits are better than expected, share price remain depressed. Company is not better even. Now image is bad. Investors say no. Hence, share price affected because of that attitude. Share valuation. Overconfidence in themselves. Most brands of the world, they believe that people don't value us properly. They undervalue us. They say they are going to purchase our share at this price. No, our price of our product is high. Price of our share is high. More than that. And hence managers may take action which are not best interest of shareholders. Such as they may delist from stock exchange. It is rare although. But they may delist. They say shares are not valued at appropriate amount. Or defending our against takeover bid. They say they are not valuing our share properly. We will not sell our shares. Now, acquisition. Yeah, even undervaluation and overvaluation as well. Why acquisitions are overvalued? Confidence, over optimism, bias. So it conflicts with the theories, capital asset pricing model. We say investors are rational. Rational. So it also explains overconfidence, cognitive dissonance, that why a manager persists with strategies. They are unlike, so those strategies, even you try to convince them, but they are not convinced. They are overconfident. They fail. They don't economic logic. They don't follow economic logic. Rather, they go for their own psychological patterns, so psychological reasons. Students, is it clear? Behavioral finance.